Let's dive in. What trends are you seeing in the last month with the housing market?
Some of the things in housing the past 10, 15 years, certain events that would have had less of an impact, like a localized economic downturn, in this period, they might have a greater impact. There's just a greater vulnerability in some of these markets today. I launched a new site for my Resiclub Pro members, and in it, I have a bunch of data. But one of the interesting things you can look at is like, where were we a year ago? And where we were a year ago was still much more appreciation than we are seeing today. Now, those places that were flat a year ago, they're down. The places that were kind of still up, they're now flat. Directionally, most of the markets in the country have seen that deceleration.
Where are you seeing them getting beat down the most?
For prices.
Lance Lambert, welcome back to our monthly Resiclub update.
Housing. Always so much going on in the housing market, especially right now.
Before we dive in, I want to show everyone an article that was published after the Fed released their minutes of their last FOMC meeting. This meeting is where they decided to reduce the Fed funds rate by 1/4 point. Woohoo! But let's just take a look at that real quick. It says the Fed officials discussed risk of housing market collapse at recent meeting. And then here it says Federal Reserve policymakers discussed the risk of substantial deterioration in the housing market during their latest meeting to set interest rate policy, according to those newly released minutes. So is your latest housing market research telling you that we're in risk of a major housing market collapse?
Well, let me pull up what Michelle Bowman had said, and she's a Fed governor. Yeah, so Fed Governor Michelle Bowman had warned of housing market risk. Declines in prices could accelerate. Speaking at the Kentucky Bankers Association annual convention in North Carolina at the end of last month, here's exactly what she said. This is direct quote. Declines in housing activity, including single-family home construction and sales, have been accompanied by higher inventories of homes for sale and falling house prices, suggesting that housing demand has also weakened. Elevated mortgage rates may be exerting a more persistent drag as income growth expectations have declined while house prices remain high relative to rents. Given very low housing affordability, existing home sales have remained depressed since 2023 and at levels only comparable with the early 2010s following the financial crisis. I am concerned that in the current environment, declines in house prices could accelerate, posing downside risk to housing evaluations, construction, and inflation. And again, that's what Fed Governor Michelle Bowman said on September 23rd. So I think what she's really saying there, it underscores this concern by the Fed that they may have kept interest rates and kept us in this restrictive environment for too long, and that the longer we've stayed in a restrictive environment, it's weakened the economy, so kind of, soften the labor market, but also soften the housing market. And both of those two things, the labor market and the housing market, those were what overheated back in 2021, right? The economy had started to recover in 2020, and the federal government didn't quite realize how much the economy had already recovered in 2020 with that stimulus and also, beginning to roll back the restrictions on the economy. And then you go into 2021 where you have more of the economy reopening with the vaccines and all of that. And then the federal government does another round, a big round of stimulus. And then the Federal Reserve stays in an easing mode, right? They keep interest rates at pretty much nothing. They keep buying treasuries. They keep buying mortgage-backed securities with printed money, pushing all of that money into the economy while also keeping rates artificially low or lower than they would have been otherwise. That keeps housing demand red hot. That also keeps the labor market red hot. And over the past 3 years, the Fed has wanted both of those things to cool off, right? To soften. They've wanted the housing market to soften from those extremely overheated levels, and they've wanted the labor market to soften. And both of those things have softened. But I think the Fed is starting to get a little bit closer to that place where they're like, you know what? Maybe we've done too much. Maybe the labor market, if we stay where we are, we could see a really fast deterioration. Because when a labor market has been softening and job openings have been rising and, and layoffs have been up a bit, but it hasn't seen the real big deterioration. But the thing about the labor market is once it sees that deterioration, it's too late, right? It's the cat's out of the bag, right? And so the Fed's starting to wonder, given the signs that they're seeing in the labor market and given the signs they've seen in the housing market, and I can go through that data and show what some of those signs are, they're kind of like, you know what? We need to move from restrictive to at least neutral. Now, the Fed isn't going straight from restrictive to kind of trying to accelerate the economy, right? We're not going to, they're not going to do a huge cut to interest rates unless the labor market gives in more, but they're trying to come off of that restrictive.
Well, before you go into the housing data, are you tracking the government shutdown situation, how that could affect housing? Carl Gomez, chief economist and head of market analytics at CoStar Group, and they recently, maybe a year ago, bought homes.com. He has recently said about the government shutdown that it has not necessarily translated much into the housing market directly yet. The psychological impacts are another story. It definitely lends itself to some uncertainty for business, consumers, and just about anybody who relies on the federal government to provide services. And Lance, it has been said that about 800,000 federal employees are affected by a shutdown. Are you paying attention to that, or do you have any thoughts on that, speaking about the labor market?
Well, three thoughts. I think the first is that just generally the layoffs in the federal government, and there's going to continue to be more of those, it looks like, have some impact to those economies that have a greater concentration of federal jobs, right? Now, the exception there is probably like military towns. That's not quite the type of layoffs we're seeing here, but the places like Washington, D.C., right? There's going to be some impact there. And I think that, a combination of federal workers getting pulled back into the office, and I think also the layoffs, I think that that's going to begin to cool off those red hot, deep exurbs around Washington, D.C. that have been really hot for the past like 5 years plus.
Where I am
Well, yeah,
in
so I
Maryland.
think those types, like the deeper outs, right? Like, the places that are kind of unreasonable commutes, but people could do 1 day a week. I think some of those kind of lose some of their momentum. Um, and then the second thing, I think the actual shutdown itself, we've been through this kind of pony show and, this dance, right? We've seen this a few times. I don't necessarily, unless it goes to unprecedented levels, and you can't ever rule out that, right? Just neither side might be motivated to do a deal. And maybe we get to a federal shutdown that has a greater sting than, what we've seen in the past, right? And I think the third thing there is just really, we get, these types of news events often, and, usually they don't have too much of an impact in housing. But the thing that I would note there is housing has a greater vulnerability right now because we've went through this really big overheating and this detachment in fundamentals. So if you look at the Surfside condo collapse in 2021 and all the regulations that were passed at the state level following that, in past cycles, yeah, maybe it has some type of effect, but this had a really big impact the past couple of years in Florida, right? And I think that impact it was more intense on the market because there was such a detachment from fundamentals, right? Prices were frothier, right? So when you have that frothier prices and that overheating, and then you have episodes So the frothy prices and that overheating that we saw, right? That creates the vulnerability. But then these events kind of manifest that downside risk, right? And so I think that that's the period we're in where, some of the things in housing the past 10, 15 years, certain events that would have had less of an impact, right? Like a localized economic downturn, in this period, they might have a greater impact. And so an example of that is if you go back to the early 90s, the Northeast and New England states, they saw a notable correction in housing, right? Massachusetts, Connecticut, and a lot of that was tied to the savings and loan crisis, of course, right? But then also there was a lot of federal layoffs in the kind of that post Cold War, where we're pulling back on defense spending, and Massachusetts had a huge presence of those high paying jobs that pulled back. And so we went into a correction in some of those markets. And so what created that's what manifested the downside risk. That's what actually saw the correction manifest, right? But what had created the vulnerability was an intense overheating that had happened in the 80s, right? And they had kind of gotten to frothier evaluations. And then you have the savings and loan crisis occur, and you have the defense jobs pull back, right? And so that kind of comes together, creates a correction. And so I think that that's the third point, is that there's just a greater vulnerability in some of these markets today.
Hey guys, I hope you're enjoying the show so far. I just wanted to take a brief minute and share some exciting news. I have just released my new Todd Simple home buying course. This course is designed for anyone wanting to know how to buy a home. It's designed to take you through the entire home buying process from start to finish. You'll learn how to represent yourself should you want to avoid paying real estate commissions, the best ways to shop for a home, how to avoid costly mistakes, what to look for when touring a home, negotiation tactics, and so much more. In this home buying course, I hold nothing back. In fact, I would go to say that no one has uncovered the home buying process like I have. I've even made a way for you to gift this course to your family and friends. Visit saxrealty.education. The link is also pinned in the comments below. Now back to the show. Well, let's dive in. What trends are you seeing in the last month with the housing market?
I launched a new site for my Resiclub Pro members this week called the Resiclub Terminal. And in it, I have a bunch of data. Some of this is data that I've kind of analyzed and put in here. Some of this is from, public sources. It kind of varies. And what you can see in the country, and this is for year over year home prices, is you see still greater weakness in a lot of these Sunbelt markets. You do see a lot of markets kind of going flat, and then you see some kind of eking out some gains. But one of the interesting things you can look at is like, where were we a year ago? And where we were a year ago was still much more appreciation than we are seeing today, right? So you can see, like, here's Florida, for example, right? So here's where we were a year ago. Southwest Florida is kind of starting to see some softness. Some places are going flat, but there's still some appreciation in the market, right? You go to this year, much weaker,
Wow.
right?
Wow.
Georgia is an interesting one. Um, Take a look at it, the zip code real quick. So here's a year ago. So this is between August 23, August 24, year over year. You can see that, like, south of Atlanta is really, like, a year ago had kind of went flat. And some of the other places are still kind of like eking out some gains, right? Even though mortgage rates were so high. But as that supply demand equilibrium, looking at active inventory, as that active inventory is built up, that dynamics really changed. And so now those places that were flat a year ago, they're down. The places that were kind of still up, they're now flat. And so that when I talk about, like, that widespread softening, it's not that every market is seeing prices fall in the country, but it's that directionally, most of the markets in the country have seen that deceleration, where, if they were still seeing appreciation, it's less now, right? If they were flat last year, many of them are kind of slightly down. And the ones that were kind of slightly down last year, they're down more. The only exception, generally speaking, to that is like Louisiana and or not just the state of Louisiana, but like some of the Gulf areas like New Orleans. Those were places that the past 3 years had seen prices fall 10, 15%. And now some of those places are kind of flatlining, and it looks like are going to start to see some positive appreciation. And it looks like for New Orleans, at least over the next 12 months, it's not going to be as weak as it was for the prior 12 months.
You think that is because people wanting to buy coastal properties?
No, not necessarily. Let's dig in and try to figure it out together. Um, so New Orleans, let's go grab that. So let's see where.
This is really cool.
So here's where we were a year ago. So here's New Orleans, right? You can see here's the year over year, right? It had seen a greater blow off on prices, and now is starting to kind of really go flat. But let's look at its since March 2020. So unlike most of these markets in the country, most of the markets in the country were up 40%, right? During over the first 18 months of the pandemic housing boom. New Orleans only went up 18%. And now with this 15% drop in prices, and I think that's about what they've seen. Here it is. So they're down 13.7% from their 2022 peak. And so now they're only up 2% vert compared to March 2020 levels. And this is nominal. So this does not take into account inflation. So if you take into account inflation on a real basis, New Orleans home prices got to be down like 25% plus. Because I mean, you've had 25% inflation during this period. So to only be up 2% nominal, that's not much. So really,
But they're 2% over pre-pandemic, and so that, yeah, I mean, that would make sense. So they've sort of erased the gains during the over the last 5 years, and now it makes sense that they would start to see some normal appreciation.
yeah, that's what I'm hinting at is they're just not frothy for prices, not even close, right? And I think a lot of what kind of drove them down for prices is a bit of a different story. It's not necessarily the Austin story, and the Austin story is a lot of really high income people moved in. Were moving in from California during the pandemic housing boom. High incomes, right? Coming into the market, the number one correlation between home prices is incomes. And so when you have that big burst in wealthy net domestic migration, that's going to put additional upward pressure on prices. Prices there were up 70%, 68% within an 18-month period in Austin. And then Austin had a tremendous amount of new construction for multifamily, single family. And so as all that supply comes into the market and you see that net domestic migration really pull back a lot, fewer of those wealthy people moving into the market, and so that really creates a setup for a correction there. That's like a traditional like boom bust correction. What we've seen in New Orleans, it looks like a lot of this is, the carrying cost have went up a lot in New Orleans. I mean, if you look at home insurance, that's definitely a market that is, in distress for their home insurance. This is not.
Lance, I have to ask you. I have to stop you here. What does it cost a month to have something? I mean, this is fantastic.
So I until the end of this week, it's $299, and then it goes to $495 per year.
Okay, per year.
Per year, yeah.
That's, I mean, that's fantastic. That's very reasonable. This is,
And
you
so
have it all in here.
this product is really great for like, especially people in the industry, right? People who are, home builders, agents, who are doing it all day, and they really need these insights. But I think there's a lot of people who could get use from it. And so here you see New Orleans. This is the non-renewal rate for insurance. You can really see that market is kind of is distressed for home insurance. And
What
this
are they doing?
well, they've lost a lot of their insurers who pulled out of the state. and the premiums have went up a lot. In terms of, like, everything that's gone into creating the home insurance shock in New Orleans, like, that specific state, I don't have all of the nuances for it, but I think a lot of it is, these insurance models, are kind of assessing a lot of risk for, those coastal areas of Florida and the coastal areas of, Louisiana, and you're starting to see a lot more home insurance shocks coming up into the Carolinas as well.
Well, great job.
Of course, California too. But that's a bit of a different story, what's going on there.
Well, are you seeing any cities, and I don't want to take you off your track of, well, what you're showing us here, but are you seeing that any cities are really, is that what we're looking at here?
Yeah,
Year over year
sure.
price declines? Is
Yeah,
that the red, dark red?
yeah.
Where are you seeing them getting beat down the most?
For prices,
Prices.
Southwest Florida. Yeah, so let's do since 2022 peak now. So, and you can see year over year, they're down, Lee County, and, Collier County, Charlotte, I mean, Sarasota County, um, these are all down about 8% year over year. And when you zoom out from the 2022 peak, you can see that, Lee County's now down 15%, Charlotte County's down 20%, Sarasota's down 15%, Manatee down 12. Some of these not as much, like Miami-Dade is still up 8.5% from their 2022 peak, but a lot of that is because even after mortgage rates shot up, Miami saw another 12% jump up in home prices. And then now they've blown off, like, they're down like 4 or 5% from peak, but that still leaves them up 8.5 from 2022 peak. A lot of the areas, Louisiana, Mississippi, some areas, Texas, a lot, West Texas, everything around Austin, Travis County, which is the heart of Austin's metro. It's down 24% from peak. Hayes County's down 22%. Williamson's down 22. Um, but Travis County, now Travis County, which was up 66% within a 18-20 month window during the pandemic housing boom, is now up only 26% versus March 2020 levels, which is pretty much on par with inflation. So the Austin market has really gotten back to trend. um,
And I think that's the important part when somebody's looking at, I mean, who knows where we go from here, whether we'll see continual declines. But I think the important thing to take note of is that people aren't putting down 22, 23%. A lot of first time home buyers, they're putting down 3%, 3.5%.
yeah.
VA borrowers, 0%. So what that's telling me as this is going into the correction mode, a lot of people are probably stuck. They're going to have to stay put for however long, or they're going to need to write a big check to sell their house.
Yeah. Yeah. Well, yeah, yeah. So, I mean, if you look at some of these pockets of Texas, uh, one of the good things was during the pandemic housing boom, there wasn't a ton of transactions right at the peak prices, right? Because it was roaring up so fast. If you go back and you look at, uh, let's see, so prices were roaring up so fast that absolute peak didn't get that many buyers to buy versus, let's say, like a, you know, '04, '05, '06, '07, right? So many of those transactions at that very peak. And so that's one thing that's helped out a bit. But in the period since some of these markets have went into correction, a lot of buyers have potentially been overpaying on price to get some of those really big incentives, to get a lot of the mortgage rate buy downs. And that's not my words. That's actually what KB Home COO had said on an earnings call back in June, is just to kind of be careful for some of these buyers who are, potentially overpaying to get those buy downs. And he had said if they need to sell in the short term, they could find themselves underwater. And they could be underwater from day one, even if prices in their market didn't fall more, if they're overpaying to get those incentives, right? And so I think that that is one thing to keep an eye out on in some of these markets that have high levels of new construction.
Do you think with mortgage rates, I mean, right now they're in the average range. If you look at the 50-year running average, probably even a little bit lower than that. Do you think the trends that you're seeing where year-over-year price declines are happening, do you think that will instantly reverse should we be seeing mortgage rates, let's just say at 5.5%?
I think that if you got down to, well, it really comes down to how do we get there, right? If we get there because the economy has significantly deteriorated, is and the unemployment rate has jumped up on a national basis to 7.5%, that's a totally different backdrop, right? Than if mortgage rates tomorrow fell to 5%, right? I think all else equal, if mortgage rates were down to 5% today and the economy was exactly where it was, we would see more demand, but we would also see some more supply too in the market. And so, what I mean by that is there's some of this churn, about one fifth of the normal housing market churn is gone right now. And this is what I really would consider the lock in type effect, where some sellers who would like to sell and buy something else, they can't do it because they can't even afford that new monthly payment, right? They can't give up their payment and take on that higher rate, that higher payment. Some of them might be able to afford it, but they don't really want to do it because it would be such a shock to their discretionary income. But if you saw rates come down enough, for some of those people, they might be willing to sell their house and buy something else. And so that could bring some additional supply into the market, and it could bring some additional demand into the market. But one thing to keep in mind is where that supply is and where that demand is could be two totally different places. And that's actually exactly what we've seen in reverse over the past 3 years. So there's been some people in states like, let's say Connecticut, right? Where, or even Illinois. And normally by now that family would have sold their house, or that couple, they would have sold their house. They were planning to sell their house in 24, 25, and they were planning to go buy in Texas, go buy in Florida, go buy in Arizona. But given that rates are so high now relative to where they were, the affordability improvement of going from a place like, their home in Illinois or their home in Connecticut to Florida, Texas, the math doesn't make as much sense anymore, right? That draw of the, no income state, right? For Texas or for Florida doesn't draw them in as much because their monthly payment would go up so much at that higher rate, right? And so if that family over the past, or that couple over the past 3 years in 23, 24, 25 hasn't sold to go buy that other property, that's one lost seller in a state like Illinois, or one lost seller in a state like Connecticut. So lost supply that would have otherwise been in the market, but it's also been lost demand to Texas, lost demand to Florida, lost demand to Arizona. And so that lock in effect actually has created a degree of the bifurcation in the market. So that shift in the migration patterns.
Where do you believe the rate would have to get to unlock this inventory?
You know, I think that it is kind of closer to that, like 5.5, 5%. Again, all else equal, right? The economy staying what it is, because if the economy, really takes a big hit, you don't necessarily have to lose your job to be impacted. If you're kind of like scared that you're going to lose your job, that's going to impact your consumer confidence, and you're going to be less willing to make a big leap, right? To make that bigger purchase. And so if the lower rate comes through a shifted economy, That's where it kind of becomes a little trickier to just to pinpoint where that number is. But I think that the surveys that I've ran have kind of found in today's market, a lot of buyers say like 5.5, 5%.
Speaking about inventory, what are you finding? We do have that seller lock in. I'm seeing a lot of sellers very remorseful that they didn't take the offer that came in when they put their house on the market. I was just talking with somebody they're in Florida. They had their house on the market for 30 days before they had an offer. It was $100,000 less than what they wanted for the house. They basically just scoffed it off and said, screw you. I'm not doing that. They have not had any offers since, and it's approaching 180 days on the market. And they're wondering whether they should have taken that, because every month they're dropping their price and they're still paying taxes, still paying insurance. They moved out too, by the way.
Yeah.
So it's vacant. There's that. And it's just it's a burden. What are you seeing with inventory?
The biggest debate in housing right now, the number one debate, is what do these delistings tell us about the 2026 housing market? And so what we've seen, if you read the headlines, you'll hear the past couple months that inventory growth has started to kind of flatline on a national basis a bit. Some of these markets in Florida in particular have kind of started to fall from their peaks this year. And, to some people, they might take that as like green shoots, right? Saying, hey, inventory's down. That's a strong sign that those markets are strengthening. But the thing is with that, my view is when inventory drops and there is an acceleration in sales, that really tells you that there is an increase, right? Like it's getting absorbed, right? It's getting absorbed off the market, it's transacting. But if you have a big jump up in delistings, and that's the reason that inventory is down, that's not, the strengthening signal that some people think it is, in my opinion. I think that because the thing is with those homes, and that this is why it's, a big debate, a big question about the impact for 2026, is do those delistings surge right back into the market when we go into, the spring selling season next year? And some of those people, yeah, maybe some will give up and they're like, "You know what? I'm just gonna stay put." Others are like, "You know what? I'm just gonna take it off the market for a bit. Maybe I put it up as a rental. Let's see if I can kinda get some activity there." And then if they do that for 3 or 4 months, but everybody else did that as well, and the rental market deteriorates further in that place, and then they come back in spring and they relist it, that'll be another pop-up in inventory. So you can see here's year over year. Florida's really flat now on a year-over-year basis, just about, it's up a little bit, but you can see last year was when it, really was seeing a huge, huge surge up in active inventory. But over the past year, that growth has kind of decelerated a bit, and I'll show you down to a zip code level here. So that this is now, and let's just go in here and kind of actually let's go back to a county level. And let's look at like Lee County. And I'm on active inventory. I need to go to active inventory count. Okay, Lee County, you can see here, had a big surge up in active inventory, has now decelerated. But every year there is that seasonal effect that happens in the market. So Lee County is seeing that seasonal impact, but it's also seeing a greater pullback in listings because of that increase in delistings. But the question there again is once the seasonal rollover is done, and we are actually, if you look at the seasonal trend, because Florida has a little bit of a different seasonal trend, they're a little bit ahead of everybody else. So historically, they bottom out right here in September ish. Yeah. Yeah. Historically, they bottom out in September. So right now, their inventory is going to see their seasonal uh, bottoming, and then they're going to begin to see their upward climb. So as that begins to happen, does it go and just do its normal seasonal decline and kind of look, or seasonal increase and kind of look like this, where the one year, the next year kind of looks like the year before? Or does it, see a big burst up in these delistings coming back into the market and see a greater acceleration? And I think that that is exactly what we got to keep our eye on for these Florida markets. And I think that that'll tell you if, this correction that's been happening in Florida, if we're kind of, if it's kind of getting close to playing out or if there's more room to run.
Well, we would need to see those inventories really stabilize and decline, and unless, like you said, the way to measure that will be what are the sales numbers? Is that inventory getting absorbed? How many days of supply there actually is. Yeah, great information.
And so here's sales, existing home sales for Cape Coral, Fort Myers. And this is, again, is why I'm like everybody, like so many people are acting like these delistings and the rollover in inventory is a strengthening for the market. But if you look at the sales, there was 1,300 for August. It's normally like 1,700, 1,800. Yeah, some of that is the lock-in effect, right? Where there's, a bit of a less churn. But then again, there's more inventory today on the market than there was in the pre-pandemic levels. So that's a lot more opportunity for sales, but yet they're at their lowest levels uh, since, I mean, you'd have to go back to '08 when they did 1,100 to find a month with less existing home sales. So this chart right here tells you that that drop in inventory that we've seen the past few months in some of these Florida markets, it's not driven by an increase in demand and absorption. It's just it's driven by delistings.
You want to move on to new construction?
Yeah, let's talk new construction.
Any updates on home builders? I know you speak with a lot of them and some of the nation's largest home builders. Anything new there that's been happening over the last month?
I think, you have heard KB Homes on their earnings call. They stated that that actually, let me just pull up the story. They stated that it looks like they're seeing some signs of stabilization in Florida, but they're not necessarily talking about for the whole state or for the resale market in general. What they're really talking about is their own business. And so, what they actually think they might have cut prices too far for now in Florida, and they're going to start to increase them a bit. But one of the things about KB Homes is they're a little unique in the giant home builder space, in that they don't really like to play with the mortgage rate buydowns and the big incentives. They prefer to just do an outright price cut if they're going to have to meet the market, which I kind of respect the hell out of that. I think that that is, that's great and that's good for transparency. And so that's what KB Homes was doing in Florida, in many of their Florida communities. Again, it varies a lot, but they're now they said in Q3 they're seeing some signs of stabilization for their business in Florida, resulting in better absorption. Again, we're talking about KB Homes, which cut more for prices than the existing market and the resale market. Where in the resale and existing market, sellers really have to be forced into price cuts, right? They will drag their feet. There is a psychological into it. A builder who makes their money on, it's like a commodity. They make their money on volume. They need to maintain some volume. And so the builder is going to be much more willing to meet a market. Just some other builders like a DR Horton prefers to do it through incentives and buy downs, whereas a KB Homes, they prefer to do it through outright price cuts. But now they think that they've kind of found the market, which means they've cut prices enough to kind of get back to demand. And so they are increasing the prices a tad. At the moment, they think they're seeing something similar in Texas, which has been one of their weaker markets. Outside of Houston, Houston's done a little bit stronger. San Antonio and Austin are really where there's been greater weakness in Florida, in Texas.
Now, the president has said recently that he wants to build more houses And I read an article that said builders are sitting on about 2 million lots and that's a record high. And then I just saw on Newsweek where they have a map of the top 20 U.S. cities with the most vacant land available. And a lot of it in Texas, Jacksonville, Florida. What are your thoughts on increasing inventory if we looked at this map? What are your thoughts if they started building more new houses in these areas? Does anything throw up a red flag when you see a lot of vacant lots in Texas? Can they sustain a lot more new inventory coming on the market?
Well, let me say this real quick, which is, the narrative that, the giant home builders have kind of, uh, you know, slow rolled building and developing, and that is, a key driver here, or that the giant builders have so much of a monopoly that, that is kind of, held back construction. I'm a bit skeptical of that narrative, um, because if you look at the data, D.R. Horton and Lennar, which are the two largest builders, and they've been getting more market share. They've been getting it through because they built more, right? And like Lennar right now, they've been in a period where they have seen their margins fall to 2009 levels, and they've seen their incentives rates jump up to 2009 levels because the past couple years they've been like, you know what, we want to take market share, we're going to build, 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 even if we're selling it for very low margins and we have to bring down prices, we're going to do it to take market share, right? And so I don't really think that the giant builders have necessarily had so much market power that they've held back new construction, right? I think that the biggest driver for the affordability squeeze that we've seen is one, I think the recent episode that we've seen in, we saw that overheating during the pandemic housing boom, right? Where there was so much demand all at once. And the federal government and, the central bank, they did all of these things to try to, you know, improve the economy during the COVID-19 recession and lockdowns that followed it, that all of those things they did, they accelerated housing demand, every one of them. Stimulus, keeping people at home, uh, which creates the work from home arbitrage effect, buying up mortgage-backed securities, which pushes rates down even lower. So that's one. And then two, I think that there is something to, the narrative of, some of these coastal, markets like, the New York Cities of the world, the San Franciscos of the world, the Los Angeles, the Seattles, and this is a multi-decade thing where they haven't necessarily kept up with their demand in those markets. They haven't necessarily built enough to sustain that demand. Or if they had built more, that demand would have absorbed it. And I'm not going to say that all of that is because of, like that whole NIMBYism, right? Some of this could just be that some of those cities are, constrained by geography, right? There's only so many places to build, right? Or that, so there's some other factors that could go into it. But I think that, those things, one of the other things, is kind of like there's this housing analyst, his name's Kevin Erdman, and his view is that uh, following the '08 crisis, we potentially, or that we over tightened lending standards. And so there's a certain segment of the market on the lower income side that maybe like too many of them were kind of getting loans in like '06 or like '04, '05, right? But maybe when we pulled that back, we took it too far and we locked out some of the people who had in prior times been able to buy. And then when we did that and we took them out of the market, that next decade, single family builders didn't really build for that group as much because they weren't there, right? And so that kind of, potentially impacted the market. But so that's a long-winded way of me getting to kind of like be able to answer your question, which is I'm a little skeptical of the narrative that's been put out. I'm gonna try to reach out. I've communicate with Bill Pulte some. I'd like to talk to him and figure out what they kind of want to do. Now, it could be that some of the things they want to do might end up adding supply into some of these markets. But the thing is, the markets where the builders have the greatest presence, those markets aren't really, you know, it's not like there isn't supply in those markets right now, right?
Yeah.
If anything, those markets have seen, supply go to levels that we haven't seen in quite some time. The places that are kind of tight that you would like to see some of that more of that building are in some of these secondary, third markets in the Midwest and Northeast. But the reason that builders aren't in those markets is they're a little worried about, like, what is the long-term outlook for demand in those places. Yeah, Illinois is tight today. Yeah, some of these places in New England are tight today, but they're also, getting old faster, right? And they don't.
And the median prices are nowhere near where they are in some of these other markets. So you're competing with that existing home market where you could still buy a nice house for $200,000.
Yeah, so I'm a little bit skeptical. I'm kind of still learning what they want to do, but I want to reach out to Bill and kind of figure out a better idea of what they're trying to do. Uh,
The question that comes to mind uh, when we're looking at sales being so low, home builders have been offering fantastic mortgage rates locked in for 30 years. I mean, they have been doing this since, I think, 20, definitely since 23. They've been giving other incentives as well. And now they're cutting their prices, but yet the cost to build the houses isn't becoming cheaper. It's actually getting more expensive. I mean, you communicate with these builders. What are they saying about the cost to build? How will they get these prices to come down?
well, so one of the things that has helped builders and has prevented deeper margin compression this year is that they are seeing in some of these markets, labor cost and material cost be flat or slightly down. And so you're probably like, wait, why is that happening? Because when you hear the headlines about, like, all the tariffs and stuff, you're probably thinking, like, or a lot of people are thinking, it would be the opposite, right? And well, a big part of the story is there was a tremendous amount of multifamily supply that was financed at those ultra low rates. And so in 2023 and 24, we saw that supply come into the market because it takes a while. Multifamily builds slower than single, right? It took a while for it to come in. And so in 2024, we had the most multifamily supply hit the market since Richard Nixon was president in 1974. There was a lot of multifamily supply, right? And so even with the rates being higher, given all that multifamily supply was coming into the market, what we saw was that residential construction, the amount of activity and the employment in the sector and all of that stayed higher, right? The past couple of years, even though the housing market had shifted, even though um, the rate environment had shifted. Well, if you go to fast forward to 2025, multifamily completions are now rolling over, right? They're falling, right? And the starts for multifamily had fallen in 23, fallen in 24. They'd fallen pretty hard, right? And so now we are seeing the echo of that. And there's less of this multifamily supply coming into the market. There's less of this multifamily construction occurring. And oh, by the way, in some of these markets that have weakened more in pockets of Texas, Florida, Arizona, and some of those markets, builders have pulled back on single family starts too. And so, with less of that residential construction activity, we're seeing a bit of a pullback in residential construction employment and definitely a pullback in contractor employment. And so, less demand for the workers. So, that softens those labor markets, kind of prevents them from overheating. And then the other thing is when you have less construction activity, you have less demand for the materials. So that's how even with these, the greater duties, anti-dumping duties on lumber, we've seen lumber prices come down a bit, right? Because there's just less demand out in the market. When you have a softening in residential construction, that can kind of help to buffer some of the material cost side and some of the labor cost side. And I think that the biggest issue right now for the builders has been demand in the purchasing market, which has kind of shifted. as some of that active inventory is built up in some of these markets.
Interesting. Anything else that you were hoping to cover just
No,
on this
I
update?
I think that really where we are right now is kind of a wait and see, and starting to see what is the market gonna look like in 2026. That's where a lot of my attention has gone to. Of course, Q3, Q4, in the markets that have seen active inventory build up more, those markets on the ground are gonna feel really soft right now. They're already feeling really soft right now. And so, if you're somebody out trying to, transact this year, this is one of those seasonal windows where you can get some leverage, where some of those sellers in those markets that, maybe let's take a seller who listed in like April or May, right? Or June. And if they still haven't gotten a buyer and they're still on the market and they've done a series of price cuts, that tells you have some leverage with that type of buyer, right? And so I think that seasonal impact, that's definitely in play in those markets that are softer and weaker today. But we knew that that's what Q3, Q4 was going to look like. So more of my attention is looking at 2026 and trying to figure out, what happens to these delistings? Do they come back? What does that kind of look like? And do more of these markets that have been, kind of tighter, up north, do they, loosen up more into 2026?
Well, thanks so much, Lance, for your update. And for anybody listening, Lance Lambert, he's everywhere on social media. You can follow him on X, he's on LinkedIn, and you will, if you're on social media, you're seeing his graphs and charts and stamped Resiclub. All of his information is also in the show notes. Sign up for his emails. And if you're certainly in the industry or something that somebody that relies on up-to-date housing market information, I mean, you can't beat this new program you have, Lance, for less than $500 a year. I think it's congratulations.
Well,
Great job.
thank you, and thanks for having me on. And I'm really excited to come back next month and see where the housing market is then.
Sounds good. We'll see you next month.
Chat soon.
Thanks so much for watching. If you liked the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.